Assalamu alaikum, ladies and gentlemen. We have a registration for about 230 participants, but so far we haven't had that many. What we'll do is we'll start our presentation now, and we'll break for Maghrib prayers at about 10 past 6. By that time, hopefully, we'll have all the participants ready here. Before we start this evening's program, I'll request Mr. Kashif to recite a few verses from Holy Quran.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم قل هو الله أحد الله الصمد لم يلد ولم يولد ولم يكن له كفوا أحد صدق الله العظيم.
Jazakallah. On behalf of Southern Region Committee, I'd like to welcome you all to our presentation. Second wave on IFRS. The reason we're calling it second wave is we've had our first wave in 2004. You'll all recall that Fahim covered all the changes that came in 2004. Now this is the second wave of IFRS, and as part of the improvement projects. As you're all aware that due to the recent financial meltdown, few amendments have been made by the ISB. Fahim will also be covering that. Before I invite our presenter, Mr. Fahimul Hassan, I'd like to briefly introduce him to you, although he needs no introduction among the accountants. Mr. Fahimul Hassan is an assurance partner in the Karachi office of A. Ferguson, member firm of PricewaterhouseCoopers. He has a vast experience in the field of audit and assurance, and during his professional career, he has served Pricewaterhouse Singapore from 95 to 97. He has keen interest in learning and education, and he oversees the learning and education activities within the firm. He's been a member of ICAP's education and training and CPD committees, and he's also represented ICAP on local and international forums. Before I invite Fahim to present his paper on the second wave of the IFRS. There are a few announcements that we'd like to make. As I said earlier, we'll break for prayer in the next 20 minutes. And then after that, we'll continue with our presentation, which will be followed by question answer sessions, which will be followed by mementos. And after the concluding remarks by the session chairman, we'll all have dinner. With that, I'd now like to invite Mr. Fahim Hassan to present his paper on second wave of IFRS. Mr. Fahim. Could I request all the participants to put their mobiles on silent mode or the meeting mode so that he doesn't break the flow of presentation, please?
Assalamu alaikum, ladies and gentlemen. Just a slight change from the format, as mentioned by Nadeem. I would like, because of the length of the whole session, and there are various elements covered in it, I would like the questions answers to be, as you remember in the last sessions we held 3-4 years ago, if you raise the questions right at the end of that component, that would facilitate both of us. So we will probably, I'll be taking questions along the way, right? Okay, the agenda is quite comprehensive. We'll be covering almost all the amendments which have come during the last 1 year, in fact more than 1 year. Um, there would be two full standards covered here, IFRS 3 and IFRS 8. These two standards are required to be covered because these are substantially revised, and I'll be covering both of them here. The rest of the standards, there are amendments in. So, for example, IS1, IS23, then in IS27, IFRS 1, there is an amendment relating to cost of investment. Then financial instrument, there are 2-3 amendments relating to that. Then in IFRS 2, there is an amendment, and then there is a credit crunch amendment, which is reclassification of financial assets. Then there is an IFRIC update, and in this update, we'll be covering all the IFRICs which were issued during the year. In fact, I'll be covering IFRIC 13 and 14 also, which were issued in fact before 2008, but these are important and we'll quickly be running through them. Then we'll be covering the improvements projects which are going on, and these are annual improvement projects. So in 2008 improvements, what has changed, what improvements have come up, and then 2009 improvements, which are at the moment at exposure draft stage, not finalized yet. Then I'll quickly run through the expected third wave, which would probably be in 3 to 4 years' time. Okay, IS1 has been revised effective January 1st, 2009. There are consequential amendments in other IS and IFRS. It was a joint project, as you all must be aware that ISB and FASB are under an MOU signed by them, are running joint projects for the convergence of the accounting standards. And the first completed standard under that convergence project was business combination, which we'll be covering today. But there are other convergence projects which have been completed. So IS1 is part of that. IS1 has been broken, the convergence has been broken into 3 phases. Phase 1 is complete, and that is what we are discussing today. Phase B is at the moment as a discussion paper, and there is an exposure draft out in the last quarter of 2008. There are a few more changes in Phase B. Then Phase C is still very premature, so once these 2 phases finalize, then Phase C will come. In the Phase B, what will happen is actually that the components of financial statement, the balance sheet, P&L, cash flow, would be divided into 5 sections. That is business, financing, income taxes, discontinued operations, and equity. Business would comprise of operating and investing activities. So they are changing the components of these statements. Expected date of issuance of Phase B is 2011. Okay, coming to the Phase A, which is applicable from this year. Balance sheet has been renamed as a statement of financial position. Cash flow statement is renamed as statement of cash flows. P&L is renamed as a statement of comprehensive income, to be presented in either a single statement, which is the statement which we have in practice, or 2 statements, which means one would be the income statement and the other would be called a statement of other comprehensive statement. But those items would be separately disclosed from owner's changes. The statement of other comprehensive income under the 2-statement approach is the same as the statement of recognized income and expenses. If you recall, in the last amendments made in IS1, Some of the items which normally we used to take a hit on the P&L, the IAS allowed to be taken out of the P&L and recorded straight into SORI, which is a statement of reported, recognized income and expenses, and those were reported as part of the equity. So effectively what had happened was that the P&L was made free of those charge or gains, and all those gains and charges were taken directly into equity through this statement. Now, in the convergence, it is agreed that nothing should go in the equity, everything should be routed to the P&L. So it is actually going back to basics, which we always believed in, that SORI should not be part of equity, it should be part of P&L. So the statement of other comprehensive income is actually that statement which has become part of P&L itself. It's only that it has been categorized separately. There is a normal P&L, and then there is a statement of other comprehensive income, just to identify them separately. So what comes under this statement? Gains, losses recognized directly in equity net of tax. Gain on revaluation, right, at the moment these were recognized in equity, but now it would be reported in the P&L through this statement. Gain on revaluation of land building, unrealized gain losses on AFS financial assets, actuarial gains losses on retirement benefit plans, currency translation differences, and gain loss on cash flow hedges. So these would be all routed through P&L now. Reporting owner changes, all changes in equity arising from transactions with owners and associated tax impact in a statement of changes in equity. So a statement of changes in equity would be only owners related transactions. Nothing relating to company would fall in this statement as it was done in the past. Components of income and expense and associated tax impact out of statement of equity, dividends per share to be presented in as statement of equity or in notes. Other matters, the requirement of IAS 8 has been also amended because of IAS 1. Now because of any change in policy, the revision has to be not just the disclosure in the comparative have not only to be revised, but there has to be an opening balance sheet presented also. So now there would be 3 balance sheets required, including the beginning of the comparative period. And other reclassification adjustments, for example, recycling of AFS reserve at disposal should be disclosed with the related income tax. So what will happen is that once these items in the previous slide, for example, this second item, once this is realized, it would be routed through, it would be taken out of a statement of other comprehensive income, and the realized gains would go up into the main P&L. So there has to be a recycling process also. This is just how would it look actually, the P&L. This is the normal P&L, the revenues, the cost, operating profit, financing cost and income, share of profit loss of associates, and then profit before tax, income tax, discontinued operations, and then profit for the year. And then comes the other comprehensive income, which is here it is single statement form. I have broken it just because I couldn't present it on one slide. So it is all one statement going down. So other comprehensive income would include all those items as I mentioned. And then at the end of that, you can see a couple of things additional here. There has to be tax impact calculated separately, either here, or there can be a column inserted here for, if it is a separate income statement, then you can insert a column for before tax, tax impact, and after tax impact. So these are before tax. Whatever is tax net impact on above is taken here. Then other comprehensive income for the year net of tax comes to this amount. Total comprehensive income for the year, which is this plus the profit coming from the previous slide, 32,315. So this is the profit for the year. Then profit attributable to the equity shareholder, and then MI, and then same for the comprehensive income. This is a note for the income tax expense. As you saw in the previous slide, there was a summary there. Here you can see the tax charge or credit coming in this column, and all those items have been taken as before tax, then net of tax. This amount, this amount is reported there, and the net amount of tax is reported in the P&L. So there has to be a note specifying as to the breakup. This is other reserves note, and this would essentially demonstrate as to how the recycling would take place. If you notice here, for example, the AFS financial assets and associates, gains arising during the year would come in here, and then any gains which have been realized would be taken out. So this like 130 is the realized gain and taken out of this statement, and the remaining balance goes into the statement of other comprehensive income. Same is for other items. So any movements have to be shown, and recycling process has to be disclosed separately. Okay, so that was IS1. Any questions if there are? Then we can quickly move to 23. Fortunately, there are not many amendments in 23. It was again a convergence project. Revisions primarily concerned with eliminating the option to expense borrowing costs. So now the option is gone. Now all the borrowing costs have to be capitalized. Enhances the view taken is that it enhances the comparability and overall improvement in financial reporting. Effective for annual periods beginning on or after January 1st, 2009. Earlier application is permitted, but disclosure has to be made. Highlights removal of allowed alternative treatment for immediate recognition of borrowing cost expense relating to qualifying assets. Capitalization of borrowing cost as a compulsory treatment. The cost of an asset will in future include all costs incurred in getting the asset ready for use or sale. So the argument given in favor of this, this treatment was, or rather eliminating the allowed alternative treatment was that most of the time companies utilize borrowings to finance their capex, and it obviously brings variation if one company is using expense method and the other one is capitalizing, so the valuation gets affected. And again, so far we haven't really gotten rid of the cost model for the property, plant, equipment. It is still being used, the cost, historical cost. So unless we move to fair value model completely, obviously this need would go away. But until then, there has to be a consistent mechanism. So it was decided that to eliminate variations, every company should be capitalizing borrowing costs. General requirements: capitalized borrowing costs directly attributable to the acquisition, construction, or production of a qualifying asset. Directly attributable borrowing costs that could have been avoided if expenditures on the qualifying assets had not been made. Costs of general borrowings used to obtain qualifying assets by applying capitalization rate to the expenditures on the asset. Now there is obviously always a gray area as to companies manage their financings on a centralized basis, and a lot of times they are also financing working capitals and other assets from the same cash flows, borrowings, I mean. So in that situation, the argument was that we can't really identify which funds were used to really for this asset. So the standard has eliminated this confusion, and it is assumed that if there is any borrowing, it would be first used for the construction of that asset. And then it would, if there is obviously more borrowing, then it would be used in other activities of the company. There is a capitalization rate, which is the weighted average borrowing cost other than cost of a specific borrowing. So if there are specific borrowings relating to one project, obviously it makes life easier. You will capitalize that. But if they're not, then or if there is a mix, like there is a specific also and there are general borrowings. So whatever is specific would be capitalized straight. Whatever is falling under general, there has to be a capitalization rate determined first, and then it would be capitalized on that asset. Qualifying asset that takes substantial period of time to get ready for intended use. We all know that. Capitalized when? Now the standard further elaborates. Borrowing costs are being incurred. It has to be incurred in actual, and asset preparations are in progress. So if there are visible activities and commitments, like the company has signed agreements and acquired land and things like that's happening, then only you can assume that the asset preparations are in progress. Then there is a concept to suspend capitalization when the active development interrupted for extended periods. So it should be suspended for those periods, and the capitalization should cease when activities to prepare the asset to be used are complete. Other points: income from temporarily invested proceeds from borrowings. Now it is required to be offset against the borrowing cost. So if company borrowed money for a specific capex, and for the time being the funds are sitting idle and these are kept in a short-term investment, so whatever the returns coming from there have to be offset against the total borrowing cost, and after that it can only be capitalized. Financing of long production period of inventories, for example, while the example given is wine, but there could be other long-term inventories which take time to ripe or to be produced. In that case, management can choose. Now here is an option. In inventories case, there is an option that management can choose to capitalize borrowing costs, but in fixed assets, there is no option. Notional borrowing cost is not possible. Sometimes there was an argument that asked every company to capitalize a notional borrowing cost, but the IESB does not agree with that concept. Operating cash flows sufficient to finance capital expenditure. General borrowings are assumed to be used first for qualifying assets. We discussed that. Therefore, borrowing cost should be capitalized. Finance lease interest cost is an element of borrowing cost to be capitalized. So I think these are all we. Okay, in your files there are certain handouts, and I'll tell you why these are kept separately. These handouts are inbuilt into the presentation, but I don't think these are visible from there. So please refer to your handout, and these are some very, very good I would say quick notes to refer to. Once you go back, you can always refer to them, because these are some flow charts, some guidances which have been put together in a nice manner, which will help you in determining how to, for example, in this case, what has to be seen, I'll explain to you. Definition of qualifying assets, we know which assets, not working. Which assets qualify, what are the examples, and which assets do not qualify. For example, financial assets do not qualify for capitalizations. Inventories which are routinely manufactured, assets that are ready for their intended use. So then if they are not qualified, no capitalization of borrowing costs. But if they qualify, then we have to check the scope. Assets measured at fair value. Now, this is another area. If an asset is already valued at fair value, then there's no point in capitalizing further interest costs on that. So, if it is not an asset which is valued at fair value, then you further check if the asset falls under inventories categories, and if the inventories take longer period of time, then only you go for capitalization. So in that case, there is an option. Otherwise, you come to the borrowing cost itself, and you need to see what are the components of borrowing cost. If that is there, then you go and are the costs actual or imputed cost of equity. Now this is very clear that no imputed cost of equity can be capitalized, including preferred capital not classified as a liability. So if that is the case, that is not covered under IAS 23. Then directly attributable borrowing cost, yes. Is it probable that the borrowing cost will result in future economic benefits to the entity, and can they be reliably measured? Yes. Recognition of borrowing costs eligible for capitalization. If it is a specific funds, then the whole cost would be capitalized. If it is general fund, then determine borrowing cost eligible for capitalization as follows. We need to work out the capitalization rate and then apply that rate on the amount of asset to arrive at how much is the capitalization amount. Progress payments and government grants. Progress payments received and grants received in connection with the qualifying asset should reduce the amount of capital expenditure subject to capitalization. Commencement, suspension, and cessation, we discussed that. If there is an impairment, and there are indicators that there is an impairment, you are not allowed to not capitalize interest costs because there is an impairment. You still capitalize the interest cost, but you test for impairment, and whatever is the difference, you book a separate impairment. So that's how impairment is taken care of. Shall we take a break now? So the break would be for 20 minutes, and we reassemble at 6:30. Okay, as I mentioned earlier, this is the first converged standard, the convergence project between the ISB and FASB. Initially, if you remember, we had IAS 22. In the US, there were APB 16, FAS 10. Then in 2004, IAS 22 was replaced by IFRS 3. And there was FAS 141 in the US. And now all these two streams have converged. So the revised IFRS 3 and IAS 27 is in line with FAS 141 revised and FAS 160 in the US. So all these standards have more or less converged. There are minor differences still there. The IFRS journey, just to recall, we had pooling of interest method in IAS 22. The pooling of method was done away with in the IFRS 3 few years ago. Then purchase method, we only have it now. We call it acquisition method in the revised standard. Is it visible? Under 22, these were the major areas which got changed into the IFRS 3. So purchase method is now called acquisition method. MI share of net book assets at book value we used to have. Then we had a revision there. Now at fair value, in the new standards we call MI, we don't call MI, we call NCI, and NCI is valued at fair value now. The goodwill was measured only parent share. Goodwill was amortized, if you remember. Goodwill amortization was allowed for 20 years. Then the goodwill in the new standard and under IAS 36 also, the impairment testing was introduced. Instead of amortizing, it was to be impaired. The transaction cost could have been capitalized in the old IAS, not capitalizable anymore. Even in the past, it could have been capitalized, but under the revised IAS, IFRS, it is not cannot be capitalized. So now we have acquisition method, we have net assets at fair value, we have goodwill parent share, and goodwill includes NCI share also. So we can have one of the two treatments, either have goodwill including NCI share, or we can have goodwill only parent share. So the principle is that all combinations apply the acquisition method. Now, we'll discuss about the principle first, and then we'll go into the details. The IFRS has very clearly, categorically said in the beginning that all combinations have to apply acquisition method. Components of a business combination are measured at fair value. So whatever is done at fair value. There is no other, there are a couple of exceptions as to which items can be valued at other than fair value, but generally speaking, the whole combination has to be at fair value. And then accounting for only what we have gained control of and what has been transferred for that control. So it has become very comprehensive standard in terms of what is consideration. So previously the consideration was restricted to only the cash which was transferred or some equities which were transferred. Now it is a very comprehensive definition, taking into account all the various aspects of a business combination. This I will explain in detail later on. The amount paid plus any previous interest plus the minority interest, which is non-controlling interest, is the total sum which has to be compared against the fair value of the assets and liabilities and contingent liabilities which have been acquired. So it is not this block comparing against this block anymore. It has to be all these three blocks totaled and compared with the asset liabilities fair values, and the difference is goodwill. So there is a primary definition has been changed now. We'll discuss it in more detail. Okay, this whole fair value philosophy has been completely built into this standard now. So now we can say that IFRS 3 takes into account all the various aspects which could have been eliminated in the past standards, which were not taken care of. Now they have been taken care of in the new standards. So everything has to be valued first at fair value, and then the consideration has to be compared with, and then the goodwill has to be recorded. And once the goodwill has been recorded, it is a frozen goodwill. You can't touch that amount. Like in the past, you could have adjusted some of the elements against the goodwill in a future date also, but not anymore. The amount of goodwill is fixed for the rest of the life of those companies, and it can only be impaired, and obviously there has to be a testing for impairment every year, and there is only another adjustment against goodwill, that is only deferred tax adjustment. I'll explain to you later on. Deferred tax would be adjusted against goodwill. There's nothing else which can be adjusted. So the changes which have come about would have various implications on the earnings. It would have drop earnings for the share options given to seller. The share options now would be treated as against the future service cost. So if I'm giving share option to the seller, and seller is still going to work for that same business combination and has to remain part of the business combination, that those share options would become, would fall under IFRS 2, and there would be an adjustment with respect to those options. So there would be a charge on P&L. Previously, you could have taken that into equity. Now it would be a charge on P&L, so the earnings would go down. The transaction cost would be charged to P&L now, as and when incurred, so there would be a decline in profits. There are earn-outs which would essentially be their performance-related share options. Like if in a business combination, the management is retained and the management is also the seller, and I give some share options to them, or I commit with them that if the value of the company increases in future, you will get these options. If it does not, then you will not get these options. Things like that. So the earn-out could increase the profits in the future. If the performance is good of the company, obviously it will enhance the profitability of the company. If it's not good, it would decline the profitability of the company. Existing interest held in target, if you have, let's say, 10% interest and then you acquire another 50%, so it goes up in that manner, and there is a specific accounting treatment for that. Full goodwill is recognized, so goodwill values would have swing there. Pre-existing relationships have to be all accounted for. So because the business combination is now an event which is giving a new birth to another arrangement, and that's why all the fair value measurements are applied. So when there's a new birth, all the previous arrangements have to be discontinued, and all the pre-existing relationships have to be settled there as at the date of combination, and whatever gains losses are there have to be recognized into the P&L as at that date. Indemnity from seller, whatever is there has to be recognized, and it can vary. And the purchase or sale of minority, it is only a transaction between the two shareholders now, so it would just keep on changing. It would have no impact on the P&L. So these are the ones without P&L impact, and these are the ones having up and down impact on the P&L. Okay, the areas we'll cover here, the scope, and actually it's combination, it's not consolidation. This is combination, wrongly written. Scope and applicability, method of accounting, consideration, goodwill and non-controlling interest, asset and liability recognition, and there's some other issues. So these are the main areas in this standard. We'll discuss one by one. Scope, it now includes combinations of mutual entities and combinations without consideration, which were previously excluded. Now they have to be, IFRS 3 would apply on these combinations. Definition of a business has been amended slightly. It now states that the elements are capable of being conducted rather than are conducted and managed. So bring more transaction into acquisition accounting. So if there are synergies and if there are business reasons to acquire another business, then definitely there is going to be a business combination. So there has to be an economic substance behind the transaction. So previously there was an argument if the wording was that they have to be conducted and managed together, then this standard was applicable. Now, even if they are capable of being managed together, the combination would apply. Common control transactions are out of the scope of this standard, as in the past. JVs, businesses under common control. By the way, there is a separate project by ISB under which they are working on a new standard on joint ventures. So that would take care of any combinations coming out as JV combinations. Applicability is July 1st, 2009. Early application is permitted, but IS 27 should also be applied if it is applied earlier. Prospective, previous accounting largely unchanged. So whatever accounting has been done by the companies until June 2009 for the previous transactions, all the acquisitions or mergers, whatever, would not change by this new standard. So this standard would only be applicable on new transactions, which are taking place effective July 1st, 2009, or afterwards. First of all, we need to understand as to steps in applying the acquisition method. Method of accounting, only acquisition, obviously we discussed that. What are the steps in applying this acquisition method? The standard elaborates on 4 steps: identification of the acquirer, the combination entity that obtains the control of the acquiry. So this is essential because the whole accounting treatments revolve around the acquirer. If we, by mistake, select a wrong entity as an acquirer, the whole accounting would be wrong. So the acquirer has to be identified in a business combination. And sometimes because of reverse takeovers, the acquirer is difficult to identify. Determination of the acquisition date, the date on which the acquirer obtains control. This is very important because if we wrongly took a date, the values can be different. The values of the goodwill ultimately can be wrongly calculated. So the acquisition date has to be determined, and this is the date when actually the control is transferred. So if there is an agreement, there is a press release, announcement, all the rest, no combination accounting, only disclosures would go in the accounts if there are accounts there. But the accounting would only take place when actually the control gets transferred. Recognition and measurement of the identifiable assets and assets acquired, the liabilities assumed, and any non-controlling interest in the acquiry. So which assets are being acquired, which liabilities being assumed, it all has to be identified, and how they would be recognized, how they would be measured, because there are different treatments for different areas. That has to be done. And then recognition and measurement of goodwill or a gain from the bargain purchase. So if we are paying more for the assets we are acquiring, then there is a goodwill. If we are paying less for the net assets we are acquiring, then there is a bargain purchase. Previously it was called negative goodwill, now it is a bargain purchase. Under the standard, we must recognize that in the P&L. So what is consideration? It comprises of cash, other assets, businesses at fair value, equity instruments, options, warrants, again fair value, contingent consideration, fair value, and any replacement share awards, which is an exception, and it would be valued under IFRS 2. So essentially anything which is part of the transaction, whether it is hard cash or with some warrants or deferred considerations. For example, you can have a transaction whereby you don't pay anything at the moment, but you pay at a later stage. So even if that's the case, it has to be valued. The contingent consideration is like earns out. You tell management that if the company performs in future, we'll give you these many shares. If does not, then obviously the number of shares would be lower. The requirement is that obviously you can't determine it at the moment. At the date of when the control is transferred, you can't really find out what would be the amount of settlement. It could be in 2 years, 3 years, 4 years time. The requirement is that you value that contingent consideration as of the date based on your estimates and assumptions, and then that would be fixed, and whatever is the amount actually settled at the end of the day in future, the difference would go to P&L. So that's how it should work. What has been transferred for the business acquired? Consideration measured at fair value at the date of the combination. Acquirer's interest includes previous holdings. All elements recognized at combination date. Subsequent changes will affect income. So as I said, that whatever accounting we are going to do, it would freeze on the date of combination. And if there are any changes in valuations of those assets and liabilities in future dates, those would all go to P&L. So that's why I mentioned in the beginning that this standard would have serious impacts on earnings of the companies in the future periods. Excluded items that are not consideration will be charged to P&L. For example, transaction costs, settlement of pre-existing relationships, remuneration for future employee services, reimbursements for paying the acquirer's acquisition costs, payment for indemnification assets. Now, I hope you all understand what it means, but as I said in the beginning, if there are any questions, please just raise them then and there so that we can move forward. Consideration, what has been transferred for the business acquired? There are issues. Acquirer previously held an interest in acquiry. As I mentioned as an example, we had the company had an interest up to 10% of the shares, and now it is acquiring another, let's say 45%. So it would become a subsidiary and it would become a combination. So the previous interest, which was, let's say 10%, would be remeasured at the date of combination at the fair value. Any gain on remeasurement recognized in earnings at date of acquisition. So if there is a gain on that remeasurement, it would go to P&L. If there is a loss, it would go to P&L. And recycle items of other comprehensive. Now, in IS1, we have just seen that the gains losses on AFS investments does not go straight into the P&L. It goes into statement of other comprehensive income first, and then when it is realized, it routes back into it is recycled. So when this thing would happen here, that we have an interest of 10% converted into an interest of 55% at the date of combination, that 10% interest would be assumed to be a disposal, and the unrealized gain relating to that 10% interest which would be lying in the other comprehensive income would be recycled back to the P&L. Options given to selling shareholders.